What's up, ladies and gentlemen? Today we are going to keep it to the point. We're going to talk about buying calls and puts and just what they are just in general at all. Okay, so first of all, just to dive into what an option is. An option is a financial contract that gives you the right, but not the obligation, to buy or sell a stock at a predetermined price with a specific time frame. There are two types of options, again, calls and puts. So when you buy a call option, you're buying the right to purchase the stock at a specific price known as the strike price before a certain date called the expiration date. So for example, let's say let's bring it up. We're on Palantir here. I know what you're thinking right now. Lots of numbers, lots of things going on. Just don't overthink it. Okay, so I just told you there is a specific price and a specific date. All down the middle right here, that's just the date on every one of these. Your price, your strike price right here, this is just all the different prices. So for example, if I want to buy a Palantir, okay, and I want to buy the 30 strike, I want to buy Palantir stock at $30. Now, I know right now it's at $23.84 if you're looking at the screen, $23.84, but I want to buy it at $30, and I will buy it because it can be between now and July 19th, as I have here on screen. I will buy 100 shares at $30. Now, if it shoots up to $40, okay, then I get to buy these at $30, and I can just go to the market and sell it at $40, and I profit $10 a share. Just on that. Imagine it's kind of like people call them coupons. I've heard people refer it to layaway. It's kind of like let me write you a check if you're old enough to remember those, but don't cash it until this date. I'm going to buy this. I'm going to buy Palantir shares. I'm going to buy 100. Each contract is for 100, both calls and puts. I'm going to buy 100 shares of Palantir at $30, but don't cash this check until July 19th. So, on the other hand, you have the put options. So, when you're buying a put option, you're buying the right to sell a stock at a specific price before a certain date. Now, remember, if you're buying a put, you're, like I just said, selling to open. You want to short the stock. Okay, so we'll go here on Palantir. Let's say you buy here's a month out, July 19th. You want to short the shares at $20. You want to sell them at $20. Let's say Palantir gets bad news. It's not in the S&P, and all the government contracts are gone, and it goes to $10. At this point, I get to sell to open at $20. I get to buy them back at $10 on the open market, again, profiting $10 a share. So don't overthink it. It really is that simple. I know a lot of people, this is a lot to take in just all at once. Just everything I just said, let's just stick to that. Key points to remember: a call option gives you the right to buy a stock at a specified price. A put option gives you the right to sell a stock at a specified price. The strike price is just what you just picked. If we want to go short, and we pick the 20 right here. We want to go long, we pick the 30 over here. They don't have to. That's when you're looking at this. The shaded area is what's called out of the money. And I'm not going to give you too much right now, but typically you see these posted on Instagram, way out of the money, and then the stock just soars, and then they profit a lot. It has to cover a lot of ground for that. But again, the strike price is the price at which you want to buy or sell the stock. All it is, right down the middle. The expiration date, again, right down the middle of when it can be exercised. Now, you can do early assignment and say, hey, go ahead and cash that check right now. Or you wait until Friday, July 19th at the bell, and then they go through and start assigning shares to everybody. Or it expires worthless. And we'll get to that in a second. The premium, fancy word, right? It's just what somebody paid. So we mentioned buying the 20 strike to go short. The bid and ask, just like you would on a stock, I can buy it for $8. Now that's 8 cents that you're seeing right here times 100 shares. 8 cents per share times 100, $8. Same with our 30 strike over here. So bid is 6 cents, 8 cents. So again, just whatever you want, just keep it simple. Again, $8. We could buy it for, that's the cost. That's what costs us. So imagine if you've ever bought a house, anything like that. That's the deposit. It doesn't go towards anything, but you got to pay to have those contracts written up, right? That's just the document fee, the admin fee, if you will, for anytime you've ever rent or bought a house. We're going to run this application. You got to put this money up. Okay, so risks and reward. The most you can lose, remember, all we're talking about is buying. It's important to remember, and I'll make another video next. You can buy or sell to open. You can be a writer. Anyway, right now we're just talking about buying. The most you can lose when buying a call or a put is the premium you paid for it. So like we said, it's going to expire worthless. Let's say you bought the 20 and it stays above 20. Your $8, the contract expires worthless. Or let's just, calls are easy for people to remember because a lot of people like to go long. You paid $8. You went right to the ask, paid $8 for 30. Now, you could buy 100 shares at $30, but right now you can just go to the market and buy 100 shares for $23.84. So that a contract is essentially worthless. Why would you do that? Why would you just pay the extra money for nothing? So that's the most you can lose, is that $8. Full stop. If it doesn't move, long story short, if it doesn't do like what you think, most people would buy this bet. They would probably buy this thinking it's going to go to 40. If you buy this $30 strike right here and it goes to $30, well, you paid $8 and you got your shares at $30. Now, it's awesome when it goes to 40, and then your $8 is worth it. So when you're thinking, if you're trying to profit, a lot of people will just flip these. Like, hey, I want to buy this for $8. I'm hoping Palantir shoots up, and I'm going to sell this contract to somebody else for 67. It's what a lot of people end up doing. A lot of people don't wait till expiration. But anyway, if it moves in your favor, that's what you're doing. You don't have to hold this thing to the end. As far as potential goes, sky's the limit on the call side. If you guys remember GameStop, it was at once $4 a share, then it went to $350. So that's again, if you had the $5 strike, you could have bought those at $5 and sold them at the market for $350. Sky's the limit. Now, when you're buying a put, most it can go is zero. So they declare bankruptcy. They just leave. That's the most you can get is so let's say you bought the $20 strike put, and Palantir goes away. It's bye-bye. The most you'll make is $20 per share, minus your 8 cents that you paid for it. So to wrap this up, buying a call is a bet that the stock price will go up, while buying a put is a bet that the stock price will go down. These can be very, very effective, whether you want to trade them or not. Even if you just want to stick to shares, it's very important you understand just the options market in general. So I'll wrap it up here. I don't know if you guys can hear my dog going nuts, but I will see you guys in the next video. I'm creating a whole bunch of videos just to explain all this as beginner as possible. So let me know in the comments down below what other questions you have. Some popular questions from beginner to advanced. Let me know, and I'll answer those in the next video.